Okay, good afternoon, ladies and gentlemen in the UK, and good morning in America, and maybe early morning in Asian part of the world. I'm Professor Sabur Mullah. I'm working at the University of Sheffield as a chair in financial management. 4 of my colleagues and I have established this academy. It's called Academy of Sustainable Finance, Accounting, Accountability, and Governance in 2021. So ASFAAG begins its journey on the 7th of May in 2021. ASFAAG is a non-profit community interest organization. ASFAAG aims to strive for producing awareness about net zero emissions, green economy, and establishing organizational sustainability through responsible business practices. To discuss and debate issues surrounding sustainability and responsible business practices, we launched this webinar series in July 2021. And Professor Douglas Cumming was our first speaker in the series. And today, Professor Sofia Johan is our 9th speaker of the series. We are really delighted for our longtime friends. Before I introduce the speakers, I must introduce my wonderful colleagues who have been supporting the Academy since last year. I'd like to invite Saeed Akbar, Professor Saeed Akbar. Saeed is serving as the Senior Vice President of the Academy. So Professor Saeed Akbar, can you please say a few words?
Saeed Akbar, as Sabur has said, and thank you to Sofia for being here and supporting us. I'm a professor of accounting and finance and head of accounting, finance, and economics at the University of Bradford. So we're grateful to everybody surrounding us, including the universities, University of Liverpool, University of Sheffield, University of Bradford, and University of Southampton in particular, who are partnering ASFAAG to make this seminar series successful. And we're grateful to all of you from all over the world to be part of this great institution. So thanks to all of you for being here, and thanks to Sofia for supporting the institute and the universities which are partnering this institute. Thank you.
Thanks a lot, Saeed. Professor Collins Neetham, professor at the University of Southampton. Professor Collins Neetham is serving as Vice President and Head of Research and Development for the Academy. Professor Collins. Collins, your microphone.
Thank you very much, Sabu, for this. You might not see me, or I'm struggling to get into my laptop, but anyway, I'm on my smartphone, so hopefully you can see me, or you cannot see me. Apologies. And delighted to see Sofia joining us today. I think, as I've already been introduced, I work at the University of Southampton here as a professor of accounting, and it's been a delight to be involved in this association, which we started, as Sabu said, and really delighted to see so many people joining the series again. And hopefully, look forward to hearing a very insightful section today from Sofia. Thank you, Sabu.
Thanks, Collins. May I invite Professor Khalid Hussaini? Professor Khalid Hussaini is a professor at Portsmouth University. Khalid is serving the Academy as Vice President and Head of Communications. Professor Khalid Hussaini, can you please?
Thank you, Sabur, and thank you, Sofia, for accepting our invitation, and many thanks to all our participants to join us and support us in this academic event. I'm Khalid Hussaini. I'm Professor of Accounting and Financial Management at the University of Portsmouth, and my main research interest is accounting, governance, and sustainability as well. Thank you.
Thanks, Khalid. Ladies and gentlemen, let me introduce our speaker today. Our speaker today is Professor Sofia Johan. Professor Sofia Johan is going to talk about governance and success in US equity crowdfunding. Professor Johan's area of expertise in finance, legal and ethical issues in financial market and entrepreneurial finance and regulation of financial markets around the world. As you might be aware that Professor Johan did her law degree, first degree from University of Liverpool. So she is very much our own, actually. She did her LLM from the University of Warwick. And later on, she did her PhD in law and economics from Tilburg University in Netherlands. Professor Johan has published 3 books and over 72 articles published in top finance journals. For example, Journal of Financial Economics, Journal of Corporate Finance, Journal of Banking and Finance, Journal of Business Ethics, Journal of International Business Studies, Journal of Oxford Review and Economics. So our academic publications have been very, very well cited. Professor Johan is serving as a co-editor of Venture Capital and International Journal of Entrepreneurial Finance, and she is also serving as an associate editor of British Journal of Management. Professor Johan is also serving as a chair in entrepreneurial finance at the University of Aberdeen. She is also a visiting fellow at the University of New South Wales and the University of Cambridge. It is a great pleasure, Professor Johan, that you are here, and we really appreciate for your time and effort to agree to give a seminar at our platform. So now the floor is open for Professor Johan. I hope she will make a presentation for about 45 minutes and followed by question and answer. So for the audience, please keep your microphone silent, and we're going to take questions right at the end. Thank you very much, Professor Sofia Johan.
Thanks very much, Sabur. Thank you for having me here. I really do appreciate it. As Sabur mentioned, my studies started in the UK. I've actually been to all the universities that you've mentioned, either as visiting or just visiting friends when I was living in the UK. I'm also noticing Colin's bookshelf, which is like mine, which is empty because nobody has any books. Universities should start getting rid of bookshelves. Anyway, why I'm very excited about this is because of your amazing efforts to bring together international scholars, pan-European, cross nationals, and more importantly, cross studies, interdisciplinary studies. You've got accounting and finance and corporate governance. And that's very relevant because I think I'm a strong believer that as we try to solve today's problems in financial management, in finance and accounting, I think we need to all work together to push the studies forward. Our literature needs to be more interrelated in a way. And for example, I'm running a special issue with the British Accounting Review, and it's actually on sustainability for the Shanghai conference. And I probably in the last weekend read over 60 papers that are, it's a multidisciplinary finance, corporate governance, and also accounting in climate change. And it is amazing the quality of the papers, the nature of research that we're doing. And so I commend your efforts, and I thank you for doing this for the community. So what I'm here today is to talk about corporate governance and crowdfunding, so entrepreneurial finance. So my area of research, as you know, I'm with Florida Atlantic University now. I'm also a chair of entrepreneurial finance at University of Aberdeen. I will be visiting Aberdeen in July. So if any of you are there, hang out with me. We'll have dinner anyway. When I started with my research in Tilburg, working on venture capital. So at that point in time, which is ages ago, which is a new form of entrepreneurial finance. So, and that sort of shifted, path dependency wise, and it moved on to hedge funds and mutual funds. And then fintech started coming about. You've got crowdfunding and peer-to-peer lending. And it became interesting because to me, it was just a different form of venture capital, a different form of hedge fund investment, but with the use of technology. And that sort of broadened the area of research. But at the end of the day, that same questions still arise. In my case, I always ask, how does this work out for the investor? How does it work out for the firm seeking corporate finance? And so, that's why when we started this research on crowdfunding, I carried out research on the usual signaling effects and looking at how, what sort of projects encourage more investment from the retail investors. And so in a way, it was interesting to me in this case to look at what was applied in the corporate governance of venture capital and hedge funds and sort of mutual funds investment. And that's why we looked at crowdfunding. So it's a very simple question but onto a new area of entrepreneurial finance, right? So many years ago, before crowdfunding was, and I'll go into what crowdfunding is. Before crowdfunding was legal in Canada, we were asked, a few academics, we were asked to look at how it would affect the financial markets. So Canada or Ontario is very much into what we call evidence-based regulation. So they wanted to see if we could do research on that how changes in the regulations for crowdfunding would affect the markets. And we did. But so then we started talking to people, and a lot of the legal scholars would and the securities lawyers thought it would be crazy to allow a bunch of retail, unsophisticated retail investors to invest in startups. Because as it is, as you know, venture capitalists are so sophisticated, and they know the markets. They're previously investors. They had started up companies, and even they had problems investing in venture capital because it was a very low success rate. So the idea of allowing retail investors like us, going online and investing in startups, at 3 o'clock in the morning while you've had way too many drinks at the pub, that just seemed insane, right? So, but then we thought, but then again, and we held that aside, and we thought, but still, this was increasingly popular, right? So before I go into crowdfunding and corporate governance, let's talk a bit about crowdfunding. For those of you who are unfamiliar, it's strange because I'm so deep into this area of research. Generally, when somebody will ask me, like an MBA student will ask me, so what is crowdfunding? I always think, oh my God, has your mother taught you nothing? And then I realized that unlike my children, their mothers aren't exactly finance professors dealing in crowdfunding. So, I like to discuss it in a very simple way, as it is. It is, imagine you're a capitalist, you're a retail investor, and you're investing in startups through platforms. So you're going online. If you're familiar with online banking, you're an Amazon shopper. I do it every day. I don't even go to the supermarket anymore, and that was pre-COVID. So you go to these platforms, and you're able to be matched. It's like a dating website, except you make money and not lose money on dates, right? So you're matched with entrepreneurs who are looking for investors. You yourself, you're an investor. Entrepreneurs who are looking for money or cash or just selling their goods. There are 3 types of crowdfunding methods. So you've got the donation space. We're all familiar with this. Every time there's a disaster, there's always a GoFundMe campaign where you can donate money online, where you don't, you find a good cause and you're donating online. Usually it's, donate a cow or a well to a developing country. And then you've also got rewards-based crowdfunding, where you're buying things, you're buying products online that are being sold or introduced to the market by new entrepreneurs. And this is rewards-based. You're not investing in the project itself, you're investing in the products. You're buying, let's say, the Solo Stove or the Oculus virtual reality headset when that was introduced, or the Pebble Watch, so all these things that the entrepreneurs are testing the market to see whether they can sell these products, and you get these products before everyone gets these products. So those are reward-based crowdfunding. And then after a while, people realize, wait a minute, if I'm investing in the Oculus VR headset, and they're able to sell that Oculus to a company like Facebook for $2 billion, why should I not get some benefit from that affirmation of the popularity of the project? So then people started thinking, why can't I invest in the upside? So become a venture capitalist or an angel investor. If I like this product, why not like the company? So then these companies started raising funds, corporate funding or corporate finance, by selling shares to the retail investors. So that became equity-based crowdfunding. So that was again a bit more complicated because they had to get the regulations had to be put in place. So countries around the world, the UK being the first mover, and then of course the Europe, and then US being quite the last mover advantage, so to speak. So they changed the rules to allow securities to be sold to retail investors, which was a huge undertaking, right? So, to do this, because, the benefits were there. Entrepreneurs get access to a pool of funders that relatively, if they limited the amount of funds that the investor could invest, it seemed relatively safe. The entrepreneurs were able to get verification of their project because the more crowdfunders, the network effects were there, better than you would get on the market and through analysts. And of course, the platforms were able to list these companies or these products and benefit from that, either through transaction fees or just the traffic. And then, of course, investors were able to get access to these companies. Remember, unless you are an accredited investor, we ourselves, it's funny, we teach finance, but we're not allowed to invest in sophisticated instruments. We ourselves are only limited to bonds and equity and our real estate. So we have very few alternative investments that we can invest in. And this is a form of alternative investments to diversify our holdings. So, this is generally why crowdfunding is very popular and why it's taken off around the world. And we'll discuss this in a bit. But, so when we look at the success of crowdfunding around the world, it's our question was, what are the governance mechanisms? Again, because that's what I did when I did my PhD. That was my area of research. The governance mechanisms that will ensure safety for the investors, and also the governance mechanisms that encourage investment into these firms, right? And the prior research, you're familiar with these names, just as I am familiar with your names because I've read your papers. I wouldn't be able to publish anything without referring to your ideas. You've got Ahlers, and Bismara is very well published, and there's also Schrinbacher. But a lot of their research is based on the signaling mechanism. So, for example, Yilin and I in 2021, we looked at we coded the words, or we siphoned off the words, we coded the words, and looking at the use of very positive words versus negative words, over optimistic words used in the project announcements, or used in the project sites, right? So to determine the success rate for these projects. Bismara does the same thing, looking at pictures, whether you're handsome or whether you're not handsome, whether what race is more likely, whether your gender is more likely to attract investments, because it's a more behavioral aspect. And we're not just looking at economic factors, but we're also looking at psychology of investors, because this relates to retail investors. But as crowdfunding research is still very new, so there were indigeneity issues. And also, we never really considered the governance of it. Why? Because the idea of crowdfunding is that these young startup companies would not be beleaguered by extra governance, and therefore it's cheaper to invest in, and therefore the retail investors would be able to invest small amounts. There's a limit to what the companies can raise, and there's a limit to what the investors can invest. So that's why governance wasn't necessarily an issue. But as these limits increase, and as the number of the amounts invested in crowdfunding, it is starting to become a concern, also because of the systemic risk, in a way that, for the companies themselves, whether it is important for them to raise funds from investors that are aware of governance issues. So, and as you know, because all of you are interested in governance, and when we talk about governance now, I read there was a corporate governance center that was shutting down because corporate governance now is enveloped into sustainability, right? So corporate governance has become a key factor in the sustainability research. So it's sort of widened, and whether that's a good thing or a bad thing, but that's one of the reasons why we wanted to look at governance to look at crowdfunding for its sustainability. This is a method of finance that we would like to continue and encourage. So we looked at the governance mechanism, and it's very simple. In a sense, we were able to get data from the SEC. And when I say able to get it, it's available, publicly available, But as you know, sometimes it's difficult to think about getting the data for new researchers, especially. So we decided to collect all this data, and we created a tracker at the university. Also, one of the reasons why, because we wanted to make this publicly available to encourage more research if they were interested in the levels of US crowdfunding, because the SEC has that data on the type of securities, on the amounts raised, down to geographic levels. But also, we are AACSB accredited. So at an AACSB accredited school, that it's getting stricter now. So one of the requirements is that we have community outreach. So the professors have to ensure that they have community outreach and there is a scholarly activity. So one thing we've considered is using this tracker to ensure that our measure for scholarly activity, and community outreach is covered, because this is available to the public, and therefore, it just helps our accreditation. So again, we looked at it for June 2021. Mind you, this paper is still being revamped and as usual revised. So generally, every time it gets rejected, we just add more data because we have time, right? So that's what happens. So we look at the main elements. So we're looking at Delaware incorporation because we found that, like most companies in the US, most companies that have IPO'd, they are Delaware incorporated. Now, and of course, security design and platform governance. Now, when we talk about Delaware incorporation, I know for the Europeans, you're saying, who the hell cares about Delaware, right? We're in Europe. And we realized that. And I think we were lazy in a sense when we started. So now we're rethinking it and thinking it from a more of what are the basic requirements or basic aspects of Delaware incorporation, the corporate governance principles of Delaware incorporation that differentiate it from the rest of the states in the US, and how that can be applied throughout practically every jurisdiction, like which country has the best, which country or which state or has the best, the strongest corporate governance, and how companies that are looking to find a jurisdiction, they should consider these sort of jurisdictions with these sort of corporate governance principles. And so I know we use the Delaware incorporation because there's been a huge debate about whether Delaware is good for IPOs or bad for IPOs. It's a Delaware effect. So we use that, but I think in this case we can extend beyond that and sort of compare it to other jurisdictions and make it less US centric. And of course we looked at security design, whether that matters. So it's different from signaling effect. It's more so whether the retail investors are familiar with this Delaware incorporation or corporate governance principles, or the security design, what they're familiar with, and of course the platform governance, whether that matters, right? So as I mentioned before, why do we look at Delaware incorporation? We know that the Delaware effect is well known. It's Romano Daines covered that. So it affects firm value. Delaware is when most venture capitalists will ask that companies be Delaware incorporated if they want to go for an IPO. So you remember, you can be incorporated in Delaware, but you can still carry out your operations in other states. It's just your main incorporation is in Delaware. But then since 1985 and 2002, other works. I mean, as you know, the minute you find a breakthrough, finding in academics, there'll be 500 academics telling you you're a moron, right? So it's the same thing. So Subramaniam and Gompers found that the Delaware effect has disappeared using different data sets, but we are still certain that this Delaware effect with regards to corporate governance is important, right? Especially because when you talk about the Delaware effect or the Delaware principles, we'll talk about this in a while. But we think it would be, there's still a role for the Delaware incorporation or the incorporation within a very strong corporate governance area for smaller firms. Because remember, crowdfunding firms, because they're startups, they don't have the level of governance that larger firms would have. that you would have analyst oversight. They don't have that. You'd have institutional investors. So crowdfunding firms, these are new startups. This is pre-VC, right? So we think that there's really few governance substitutes for these crowdfunding firms seeking investment. Also, the Delaware effect for the investors, there's legal familiarity. Everybody knows it's great. It's sort of like, if you're positioned within the city of London, everybody knows that that's friendly, right? Or Germany, everybody knows the cars are really good there. So you get the idea there. Everybody knows Delaware. Well, when we say everybody, for academics in the US, which means America, which means basically everybody, right? So we're going to change that so it's a bit more applicable towards the world. And of course, there's still legal uncertainty for small firms and the retail investors investing in these small firms. And so we think that the unquestionable sanctity of the judiciary within Delaware, how business friendly and how pro-business they are, will mitigate any uncertainty for investors. And so that's it's just the quality is well known, so that there is familiarity with that. Also, another reason why the Delaware incorporation is important is because the Jobs Act, for example, authorizes, is very different. If you invest in a startup in crowdfunding, you can actually carry out take civil action against the directors and officers for misleading crowdfunding investors. That means for fraud and what have you. It's slightly different because unlike other companies that get corporate finance elsewhere, that's not the case, right? So Delaware, on the other hand, permits indemnity for the directors. So and also, you can purchase liability insurance. So it's sort of like I don't know whether it's been tested yet. I haven't checked the law journals, but it's sort of like for the companies, they like Delaware incorporation because they have the backup where Delaware allows them to limit the liability, but the Jobs Act doesn't. So the retail investors like the fact that they may be able to sue. The directors like the fact that they may not be able to sue. So it's still a balance. So we're still trying to figure that out. And of course, for M&A, we've all heard about what's happening to Twitter and Elon Musk. And the poison pill, and so with Delaware, because Twitter is incorporated in Delaware. And again, I checked because if I have Twitter shares, I need to know what's happening, right? So with Twitter incorporated in Delaware, then the poison pill might not necessarily work. So Delaware facilitates mergers and acquisitions. That's why a lot of institutional investors in startups or small companies prefer Delaware, because then the M&As will be much friendlier towards the investors that need to exit, right? And of course, there's less managerial entrenchment. You are investing in these companies, very, very early on. You want to make sure that if the managers are not able to manage larger companies, and we've seen this in venture capital where the founders are unable to manage larger companies, then Delaware will be able to allow them to terminate these managers. At the same time, because this is the case, there's research that finds Delaware firms actually attract higher quality directors on average. So that led us to our first hypothesis, which is, if you are incorporated in Delaware, you're more likely to get the stated aims. You're more likely to get the money that you're looking for, and then you're more likely to succeed. When we say succeed and more likely to get the money, we differentiate that because in crowdfunding, and this is done, there's research in the US, in crowdfunding, the model is it's all or nothing. So in Europe, there's also keep it all. What that means is, when you are a retail investor investing in a crowdfunding portal, and let's say the firm is looking for £1 million. Now, if they get £999,000 from the investors, they can either keep it all, they keep the 999,000, or if it's all or nothing, they have to return the money unless they get the $1 million floor. The reason being is that for some deals, for some projects, if you don't achieve, let's say if you want to produce watches and you need to buy a production facility, and the production is $1 million. Now, if you don't get $1 million, you're not going to be able to produce these watches. So that's why you can't proceed with the project. But there are other projects, for example, that are scalable. So let's say you want to, you want to launch a new album, right? So you are trying to raise $100,000 for a new album by a band. And if you only raise 50,000. So instead of, you could still launch the album, but you have to produce half the albums that you thought you were going to produce. So those are scalable. So that's why some platforms in some countries allow keep it all and all or nothing. But in the US, to mitigate the risk, they had keep it all, it's all or nothing. So that if the crowdfunders don't raise the funds requested, then they are not able to continue. They cannot keep the funds. So that's why there's success, unsuccessful, right? So there's a problem where they may have raised, let's say 75% of the funds raised, and they're still attracting, but it's still deemed as an unsuccessful project. So again, so we're back to the hypothesis. We think that, just the Delaware facilities, because of legal certainty, managerial entrenchment, and just the more stakeholder friendly, these are the requirements that will encourage crowdfunding. So again, this is Delaware. The reason why I say this is because we might be changing it so that it's more, we're going to break it down to the various qualities of Delaware. So that's the second thing when we talk about security design, right? So we know, for example, there's the common shares and of course the debt, and we know, like in venture capital, there seems to be more investment in convertible securities, but for crowdfunding, we find there's more investment in common shares. But they've also created new types of securities, and we'll discuss this in a while. So the new types of securities, for example, you could have shares in an LLC. So it's sort of like a limited liability, sort of like a partnership, semi-partnership, but you could have shares in that. You have agreements to purchase shares later. So these are hybrids. These are simplified contracts provided by the platforms so that these investors will understand these investment terms more easily, right? So, and then also why we wanted to see whether security design is more important than financial statement disclosure is because for IPOs, we're always looking at the financial statements. You can only list because of certain financial requirements, right? But for the US or in many crowdfunding markets, you only need to disclose 2 years prior to equity crowdfunding in the US. And remember, in the US, as of March 2021, you can raise up to $5 million. So you're raising $5 million based on 2 years, 2 years financial statements. Think about it. Think about the last time you got a mortgage. Imagine a bank giving you a mortgage for a house for $5 million, and they only need 2 years tax returns. That's unheard of, right? So again, in the US, it's 2 years prior, 2 years financial statements, and we've looked at the financial statements. It's not necessarily as illustrative as other documentation that you would get from other types of corporate finance. And then we wanted to see whether whether it is informative enough to ensure investment. And then, of course, as we know, it's very hard to look at the financials to predict success of startups because not only is it just too few months or too few quarters, but it's still pretty nascent, right? And of course, as I mentioned before, when we look at security design, it's quite fun to look at because they have what you call simplified agreement for future equity. So these are, I suppose, in real life warrants. So you could, they're called safes. There are other hybrids that they're introducing, which is, I think, quite interesting to look at because these are going to be very familiar with investors in the future. Therefore, the more familiar, the more likely the more established companies are going to be starting to introduce this. And as we know, we've got prior research on, the risk of lemons, adverse selection costs, the usual moral hazard costs with security design. So all of you are familiar with this. And that's why we wanted to look at security design and and its relation to the amount raised and also the success of whether the probability of successfully keeping all the money. So we think because it's only for investors, their inability to read financial statements. So we think financial statements may be less relevant, and it's the security design. That means they are able to ensure that they get potential. And because they don't necessarily are able to determine from the financial statements whether they are going to get any upside potential, but at least they can ensure that they're getting it. And of course, they've got them. They know that there are certain types of securities that mitigate adverse selection, that mitigate all these moral hazards. They may not know it in the economic terms that we know it, but they just know, like, what are convertible shares, they may not know, but they know that what these common shares are. So that's why we wanted to look at the security versus the financial statements. The third thing we wanted to look at was the platform. So there are numerous types of platforms. They're not all alike. And I mean, there's dozens in the US. There must be hundreds, hundreds in I would say in China alone, right? So, and from my research, we know that they are different in how they operate, the level of due diligence, the type of the level of care that they introduce in encouraging companies to list on their platforms. Some have value-added services like the legal aspect of it, some don't. Some take ownership in the company. That means it's very much like a commission-based. So it's very much like, when you look at the commissions, it could be just like any underwriter, but not just the commission, but they also take shares in the company to ensure the company is listing there. So I can already see the conflicts of interest. And so, but I'm not sure whether the others will be able to see it, the other investors. But, we can see that there is, as time goes by, there is definite heterogeneity, which we wanted to consider. So again, we covered this earlier, but it's just the idea of the difference when we talk about financial, the intermediaries. So some, ensure that there's a high level of due diligence. Some match investors, some just, put it on a website, and it's like Tinder. It's up to you to right swipe, left swipe. Some do due diligence, some certify, some don't. So there's quite an interesting level of heterogeneity. So what we wanted to see is whether it mattered, whether platform ownership, because it will be disclosed whether the platforms will take ownership in the company, whether the investors will realize that this is a conflict, whether it will affect performance of the fundraising, whether higher platform commissions will affect performance, because just like in the IPOs, when there's higher underwriter fees, there's less cash going to the company. So therefore, it will affect long-term performance. The higher the fees, the less cash you have to play with. So far research has found that it will affect the ability for the company to make the investments. And of course, the third one, it's because of the level of heterogeneity amongst the firms. We've thought that it would be important to use platform fixed effects when we are doing crowdfunding research. And so we tested that. So our data set is primarily from the SEC. As I mentioned earlier, we have what you call a crowdfunding tracker that is available, and I will try to share it with you if we have it here. Yeah, so it's just you go into the crowdfunding tracker, and then of course you've got the tracker data, and this is of course freely available. If you look at, for example, US crowdfunding map, you can see we've got the heat map here. So if you look at Texas, the amounts raised so far, number of campaigns have been about close to 300. You're looking at about $17 million raised. You've got California, you're looking at about 1,000 campaigns. Since crowdfunding was made legal, you're looking at about 257. That's California being the highest, of course, success rate 63%. So, as an investor, you want to know, where would you want to list? I mean, if you are in Arkansas, your success rate is 33%. There's only 6 campaigns. So, so information like that, which we've made available. And you can find, for example, you've got firm characteristics, sort of, or the security type that we were looking at, what type of securities that they're using, mainly use more common stock. We've got preferred, we've got safes. This is the membership unit in the LLC, and others that are used. So let me just go back to this. So you get the idea there. So we available, but we decided to use the data to carry out the research. And so, so we have some of the, details here. This is up to 2021. So, we've got about 4,015. Remember, this is increasing on a daily basis. So the amounts raised, the mean is about 186,000. Success rate is about 58%. So you get the idea. We've got the offering amounts, we've got the success rate, and we've got the type of stock, or class A stock, class B stock. We've got underwriter commission. It's about 6. We've got about the 6%. Financial interest, it's about less, is 0.85%. And then we're going to go. So again, this is more of the financial information that we have. This is firm age, number of employees. So we'll see in a while whether a number of employees matter when we look at the descriptive stats. So, we've got Delaware Incorporation, about 45% of them is Delaware Incorporated. We're looking at post-COVID because that's important. And we're looking at the housing price index. Why we look at housing price index is because we find that, remember, when you're investing in crowdfunding, you're actually taking it out of post-tax income. So, so if you think about it as disposable income that you're able to invest, the housing price index, which is, it's your fixed cost, so to speak, is important because that really determines whether how able you are to make investments. So one thing why we're interested in crowdfunding is if you look at, the growth of the crowdfunding from 2016 to 2021, it's significant. So this is, again, these are closed campaigns. These are the open campaigns. Some of them can be open for a couple of years, some of them for a few months. So these are just the open campaigns that are here. You get the idea here. So these are campaigns that are raising more. Campaigns are raising more than 1 million around here. And remember, so up to 2021, you could only raise up to 1 million a year. It is now 5 million a year. So it'd be interesting to see how that grows. And also, it's also interesting if you think about 5 million a year for companies, how is this going to affect the secondary board, those who are going for listings right now in the IPO markets to raise smaller amounts when this is a much cheaper way for you to do it on an annual basis. These are just more information. Again, this is just when we're looking at the success rate. These are I'm just sort of going over the data here that we've covered that you can get from the details. So California, of course, is significant. I mean, why wouldn't it be? Of course, Florida is increasing compared to New York. It's actually quite interesting. We think it's because the New Yorkers have moved to Florida, but for being with the Florida University, this is why we're increasingly encouraging or introducing courses in crowdfunding for our corporate finance classes. And this is when we look at the success rate. If you're Delaware Incorporated, Delaware companies tend to be have better success rates. These are the types of engines that we have. We have WeFunder Start Engine. You may not be familiar with these, but these are the ones we are more familiar with Kickstarter and what have you. But these are the ones that are related to micro ventures. It's actually publicly listed. I just bought that for my kids. And then, of course, you've got the types of shares. I mean, if you look at the successful campaigns, in the number of employees, that you're more likely to be successful if you have higher number of employees. And again, because it's larger, that makes sense. I mean, and you've got, the revenues are much higher, but it's interesting. So, if you have higher losses, it's much likely for you to be, if you're negative, the higher the negative net income that you have, the more likely you are to be successful. And I think it's also interesting because if you're not making that much of a loss, the investors will say, well, why can't you find other ways to finance it? And then, of course, you've got amounts raised. So again, this is when you're more likely to be successful when the housing price index is higher and the stock index is higher. Let's see. Okay, so that's just sort of the data, and that to me that's not necessarily an interesting part. So now we're going over the regressions, right? And of course, many of you will probably be part of the e-please. What about indigeneity? Yes, we have that. But what we're going to do is we're going to look at mimicking variables. So we're going to look at similar campaigns in the prior quarter, but only look at the successful ones, because I mean, if you think about the companies, they're only probably going to sort of follow what the prior successful companies did. So we're looking at the prior companies, but because the prior companies may not necessarily affect the performance of the companies that listed later. So when we're looking at the support, just briefly, before you fall asleep, again, it could be after lunch for you. So, Delaware corporations, as we thought, has raised more money. And when it's common equity, you're raising a significant amount more money. And of course, but it's support. We have hypothesis 1 and 2, but unfortunately, there's no support for hypothesis 3, which again, but other than the fact that you're looking at platform fixed effects, which is still important for us, because I think it is important for future research to use platform fixed effects. So that's one thing we're doing. So this is just when we're looking at common equity, you're more likely to raise more funds. If preferred equity may not necessarily, even debt it actually doesn't. When we look at, for example, revenue growth, so when you have higher revenues, you're less likely to raise that. So maybe it's one way you can manage your performance reports as a firm. If you're high in debt, there's negative. And then of course, if the post-COVID, you're more likely to raise funds. I think it's because everybody was at home. Like, what else do you do, right? And everybody was just bored. And of course, Delaware Incorporation, you're more likely to raise funds. So of course, we've used the platform fixed effects. So, that's when we look at the amount raised. But what's also important is whether we consider the success rate, especially for a jurisdiction that has all or nothing, right? So we also know that you're more likely to be successful. That means you're more likely to achieve your target with the Delaware Incorporation, or rather, I don't want to say Delaware anymore, or rather with very strong corporate governance, being in a jurisdiction with very strong corporate governance principles. And then of course, common equity and convertible securities, you tend to have more likelihood of success. Debt reduces it. So, try not to issue debt. And of course, if we're looking at support for hypothesis 3, we do find for the success rate that the underwriter commissions, the higher the underwriter commissions, the less likely you are to be successful, but not statistically significant. But we do also find that in the data that regression fixed effects, platform fixed effects should be used. So again, we go back to the we go back to the regressions. You've got the common equity, which is again established convertibles, which is very much along the venture capital literature. Debt, not such a good idea for investee companies to carry that up, to issue debt. You're not going to do as well, but maybe for the companies, it's just they minimize the upside, giving up the upside potential. Underwriter commissions again, then we look at the same, if similar, which is number of employees. Actually, the higher the number of employees, the more likely to be successful. And then, you've got the Delaware Incorporation, as we were looking at, or rather the high corporate governance jurisdiction, the higher the firm age. So this is, for us, it was fun to look at. And we did the same thing. So we carried out the instrumental variables. We did the mimicking instrumental variables. And then, we found that it supported our findings. And then, as we looked at here, so, the mimicking variables are very much what we thought. So, then of course we did the, without the IB and what have you, every time the thing why I always hesitate to go over the indigeneity, because if there's really an indigeneity police, they'll never buy this anyway. So, so I think this is a very, very simple paper. It's a simple paper because it's not groundbreaking. This is prior research has covered the Delaware effect or strong corporate governance in other areas of alternative investments or alternative finance, especially alternative investments. We've covered this. We did this for hedge funds. We did this for venture capital. And the reason why, again, we're doing this for crowdfunding is because, it's especially for Doug and I, that's what we've done this before. So why not just apply this to the data that is coming out, and not only that, as we were collecting the data for public use, we thought it would be interesting. But I've always wondered a bit about the Delaware effect, and I never wanted to get involved in the whole debate. But as a corporate governance scholar, as a law and finance scholar, I'm still a strong believer of the Delaware effect. As long as the other academics don't watch this recording, but that's why we wanted to cover that. And it'd be interesting to see this applied to other areas of new finance. But we've always looked at from the perspective of how the firms are signaling to their investors, how they will be successful and how the investors are taking it. But there are some areas of concern that are mitigated just by the security, just by the level of corporate governance implemented by the firms, just by the issuance of securities. And these are things that have been applied to other areas of finance, but for crowdfunding. And I think it gives us a sense of security that maybe investors know a bit more than we think they do, which is great, because I highly encourage this form of funding. I mean, again, if you think about it, you can raise $5 million as a company in the US every year. What would that do to democratization or sustainability of companies and making it cheaper and easier for them to raise funds than the way they do now in other platforms or other exchanges? And considering how exchanges are now controlling exchanges are now controlling the world, maybe this is a way to allow us to diversify. So that is pretty much my presentation. Thank you very much for allowing me to present it to you. It's still a work. It is still a huge work in progress. We're still working on, tweaking it and just improving it. I mean, we've tried our best, but again, you tell your reviewers that the reviewers never believe that you're trying your best. They think you could do 100% better. But if you have any questions, I leave it to you to you crucify me. Any mistakes that you find is mine and not Robert's and Doug. So Robert is a PhD student and really, really good researcher, and he's very interested in this area.
Thank you. Wonderful. Thank you very much, Sofia, for your wonderful and insightful presentation. This topic, of course, new to me because I never studied crowdfunding or this kind of areas. So wonderful presentation. I learned a lot from your presentation. I have just a startup question. Well, please excuse me if I am ignorant in this question. So specifically in terms of corporate governance, or because I myself do a lot of corporate governance research, and I actually look into more firm-specific governance, specifically more micro governance, specifically who the people are and their kind of attributes, gender, and all task, non-task related attributes. These are the things basically I look at. So in general, your corporate governance, you are looking at more about maybe legal settings, or maybe more about the reputation, whatever I should say, because if it is a Delaware incorporated company that is coming from a strong governance background, So these are the things you are looking at. I mean, my specific question is that, is there any way that you can really find out some information about who are the people who are leading these startup companies, like who are people behind it? I know that employees are very, very few, and most of them are possibly working in the executive positions, I guess. So who are the people, whether that makes a difference, whether a female entrepreneur or a male entrepreneur is a young or experienced or any kind of, so is it possible to access any of this information, data for
Yes.
this?
Yes, it would be on the, it would be on the website. So it would be on the project website. So the project will release videos, they will release reports, they will give you the bios, the LinkedIn connections to all these. So there's a lot of research on the network effects of the entrepreneurs and just the background, whether they're science-based or, you know, or how many years, whether they're serial entrepreneurs. So there's a lot of information. Now the question is whether people are actually, it's sort of like, you know, 75% of investors don't even read the prospectus, right? So you could have the criminal check of every director. Nobody cares, right? And especially when we say nobody as in the retail investor. So in a sense, all that information is available, and that's why the signaling studies are there. You know, Sylvia does a lot of work on it. Armin does a lot of work on it. Doug does a lot of work on it. But I think what we're saying is you have to stand back, sit back and say, do the entrepreneurs, do the investors know, or they just look at the basic overall structure, which is where is it located, and if I invest in this, can I get out, right? Because remember, you're investing early stage, you're not long term. So you want to know, will this company stay afloat for the next couple of years, and can I get out? And so they're not necessarily in, I mean, I'm not saying they're not, but it's in addition to whether the entrepreneur has experience and whatnot, whether they like the company, and also just whether the shares are being offered. They have to also consider that shares are debt. And you could be the most successful entrepreneur, you've issued, you know, you've created 3 projects, but if you don't have that, then there will be that marginal investor that may not necessarily. I mean, it's for me, do I invest in Twitter because I don't even know who the board of directors are. I just know, well, if Elon Musk is involved, you know, let's figure that out.
Okay, thank you very much. Wonderful. Professor Said Akbar. Said.
Hey, thank you, Sabur. Thank you, Sofia. I think very good presentation, easy to follow. So really pleased to be listening to you. 2 things I have. In terms of the financial statements that you mentioned with minimal impact, I'm just looking into this because these financial statements are not mandated. They're not required, isn't it?
Yeah.
And it may be the case. In case those statements were required by regulation, then maybe the impact was supposed to be more. So anything on this side, in case the crowdfunding is from a company where the financial statement is mandated, the success factor will be higher as compared to those where it's not mandated. This is just one point. The other is related to one state, Dilawari versus any other state. So if we are looking into the local impact, do you think that no other state has got the facilities or things or structure that this particular state is having?
Under the U.S., under the U.S. literature, Delaware is head of the pack, so to speak. There are other states are when Delaware during the Delaware effect research in the early 2000s, they were head of the pack. But because of the success of the Delaware effect, other states are following. So that's why the researchers are now saying that there is no longer a Delaware effect because other states are following. But it is very hard to keep up because, I mean, we're talking about, you know, a type of the legal services that are very business friendly. The services, you know, the surrounding support system, the judges are all very business friendly. So, you know, and you compare about, it's very hard unless you're in the US to understand how Arkansas will be very different or Mississippi will be very different from a small state like Delaware. I mean, Delaware is so small, but all it does, it's like Jersey. All it does is just incorporate companies, right? So initially when it started, when people were noticing that that investors were asking that companies be situated in Delaware, and that the Delaware courts were coming up with very interesting, judgments that are very business friendly. I mean, if you look at majority of Fortune 500 companies are situated there or have moved there, or like their jurisdiction is there. There is still a significant benefit to a Delaware, but yeah, I mean, the gap is closing, and that's where this area of research is quite interesting. So that's why we're not necessarily, we are now moving away from saying it's a Delaware, but what we're saying is these are the basic corporate governance principles that investors are interested in, because of the fact that these are not long-term investors, because of the high risk. What they want to do is be able to invest safely and at least be able to exit, or ensure that the companies don't drown, right? So, but I agree with you. There is a possibility that other states will follow, or there may be less of a difference in Europe. So, for example, I don't think there'd be much of a difference in corporate governance between Germany and say France, maybe. But one civil, one is common law. I think so. So again, it's I'm not familiar with that area, but I would say that would merit further study. And I think your other question was, sorry, what's your other question?
It was about the financial statements.
Yeah, that's one of the reasons why we thought. I mean, for the US, when you start a project, you have to disclose to the SEC and disclose the financial statements to the SEC, the regulators. But for the platforms themselves, each one may not require it. Each platform will have different requirements. So, or they might want more detailed financial statements. The financial statements provided to the SEC may be different because we don't have access to those financial statements. They may be different. We have the ones accessible by the SEC. So that's why we have to have the fixed effects, because each platform is different. But I agree with you. That again would be interesting to study, to see whether the platforms have a higher standard or a lower standard than what the regulators require. It's sort of like some exchanges are like that, right? So some exchanges have higher standards than what the regulators require. Some exchanges are just following what the regulators suggest.
And just thank you for this. The third point is about the security design. So what is included in this? Maybe I missed something during the presentation, but what is the structure of the security design?
Well, So I think it's just the security design. When they issue common stock, either Class A or Class B, it's very similar to the security design issued by every other company in the world, right? And the convertible stock, where investors are familiar with it. But when we talk about safes or memberships, the issue there is not only are investors less familiar with this new type of security, which is an agreement to buy future securities, which is like a warrant. And you can understand, you've taught your students before, 50% of them have no idea what a warrant is other than an arrest warrant, but or an option, right? So it is very similar to every other company, except these new forms of securities. And I think that's one of the reasons, is because of the familiarity of the security design. Because you think if Twitter issues common stock, and every other company in NYSE issues common stock, then for this platform you would buy the common stock. Now, if you're starting to talk, as it becomes a bit more sophisticated, like the safes and the membership in an LLC, then it becomes a bit convoluted. So the security design is just the same, the same type of securities that are available or made available to other investors in other larger companies or similar companies.
Thank you. Sabur, please.
Wonderful. Thank you very much. We have got a number of questions lined up. First, let me invite Zainab El Rashidi. Zainab.
Hello, thank you for the presentation today. It was quite interesting to attend a seminar about crowdfunding, given that it's quite limited. I'm doing my research. I'm a PhD student at Heriot University in Edinburgh, Scotland. I'm doing my research on reward crowdfunding, so I was kind of following up with your presentation, and I was happy that you've spent your time in this presentation. It was quite good. Thank you for that. And I was wondering about the negative relationship between debt and the success rate. So if I were to guess, I thought that debt would reflect good governance in terms of the venture wouldn't be able to get the debt unless it proved some paper for the lender in the first place. And that would make the position better or give some good signals. You're talking about signaling. So give some good signal or quality signal for the fund, for the venture, for the campaign itself. But it was quite interesting to find the negative relationship in between the debt and the success rate in the research.
Yeah, I mean, so we were, so we were quite interested in that too. But I think it's also, you know, unlike venture capital in a way where it is quite common for you to invest in companies with high levels of debt, I think in this case, because it's such a startup company before, it's such a new, you know, a nascent company even before venture capital funding, where the investors are worried that too much debt, they're uncomfortable with the debt to equity ratio, so to speak. And so these companies are still, the revenues are still uncertain, whether they're able to cover the debt. But also more importantly, I think they don't really have to disclose what kind of debt they're getting. So there is a signal that if you have high debt means that that there's certification that you're able to take on this debt. There's also the possibility that you have high debt because everything that you have has been securitized, and therefore there's nothing left over for the investors, right? So you know, so we're still not sure why that is the case, but it is interesting that maybe you know, maybe if you are an investor that is only looking for upside potential and you want the cash flows, and you're worried that there's too little cash flows to affect your future you know, share valuation, it might have again, if they are sophisticated enough, it could just be that these retail investors are just worried that, look, as anyone, if you're highly leveraged, you're much higher risk. So we're assuming these you know, these investors even know anything about corporate finance, which is a bit worrying that there's, you know, you have companies raising $5 million a year from people who have no knowledge of corporate finance. But I'm glad you're doing research in reward crowdfunding. There's a huge body of work there, and it needs to be added to.
Oh, thank you. And by the way, working on different platforms, that is really needed in research, because most of the research in crowdfunding will focus only on one platform. But your piece of work is actually, I mean, it's value adding in terms of working on different types of platform and having a fixed effect for that. So
it's the data. Yeah, it's the data. The problem is that the platforms will allow you access to data if you write friendly papers, which is not what we want to do. So the data is very difficult to get, or once somebody is able to scrape the data, either using Python or whatnot, and it's or Kickstarter, or, you know, once it's available and you have, and especially with papers from Chinese data, the minute the data is released, you have 100 papers going through the journals. And I know this because I co-edit and I edit, and I'm on the editorial board of many, well, not many, but, you know, a few journals that are multidisciplinary. And you get that I see the papers that most people don't see because it's through the process. You'll see it in 2 years, but I see it now. So once I can see that when the data is released, it's like from BJM to venture capital to it's the same data. It's actually quite interesting to see.
Wonderful, interesting. Rasim Simsek.
Thank you very much, Professor Sofia. Actually, when I hear the topic, I was expecting to hear something about California rather than Delaware, because if I hear a company set up in California, it sounds always prestigious to me. And actually, I am kind of ignorant in this topic. I just check the literature, and there is something called California effect, which is the opposite of Delaware effect, right? But
yes, the California effect is VCs tend to invest in companies that are in Silicon Valley or California related headquarters. But remember, they could have legal jurisdiction in Delaware. If you check Twitter, for example, they're a Delaware company, but they can operate in another jurisdiction. So they can be a California company, but if you check their legal jurisdiction, it's actually Delaware.
I see. I see. I was going to ask about this because when you showed the map, one of the most successful companies were from California, actually, right?
Yes. So those are the raise. So that's where they raise. So they say they're headquartered in there. It's raised. The fundings are raised there. So there's not a lot of activity in Delaware itself. But the company, the legal jurisdiction, that means if you sue them, you're going to be suing them in a Delaware court. That would be in California. That would be in Delaware. So many of them, it's where they raise their funds, where they say their headquarters are, or where they are operating. But you can be a Delaware company. That means your legal jurisdiction is there, but your whole operations, you are nothing but a mailbox in a lawyer's office in Delaware.
I see.
Okay, thank you, Rasim. Next question is from Zubair. Zubair. Hello, Zubair, your microphone.
Or he fell asleep. My students do that all the time.
I was trying to unmute, I couldn't unmute.
Okay, good.
Yeah. Okay, thank you, Sofia. It was very, very informative presentation, and especially for a person like me. I'm also a novice to the idea of crowdfunding. Just some basic questions. You said you talked about the incorporation in Delaware. So my question, are these companies, like when they're incorporated, are they listed on the stock exchange or not?
No, these are not listed on that. These are very new companies. You could have 4 or 5 people, but these are not. But you know, there are a few that have crowdfunding success that are listed in the future. There are platforms that are listed where that's another area that's quite interesting also. But these are not. These are very new companies.
Okay, so they're startup firms, yeah?
Yeah, they're startups. They're pre-VC.
Okay. So again, my basic question, trying to understand what this crowdfunding really is that what's the rationale or what's the raison d'etre for having this crowdfunding in the first instance? I mean,
because
if I miss your initial point,
it became expensive to list, right? I mean, you think about the underwriter fees. If you think about the listing requirements, these are, so you would have to be able to be a certain size. Like for example, VCs now, when they invest in companies, it used to take maybe 3-4 years to get a company to an IPO. Now it's about 7 to 10 years, right? It takes much longer. The companies are larger. The companies actually choose to not be listed, to not have to get the oversight from the public, but they still need to raise funds. So that's why in this case, they still are able to list on platform. Their securities are publicly available, but through crowdfunding websites. The problem here is, you know, whereas before you would have a support system to support these public investors, but now you've got, you know, you've got investors that could be in the thousands investing for a company that is 4 or 5 people. I mean, how do you deal with that, right? So that's one issue. But you know, they're still very, very young. But yes, can young companies raise $5 million a year? Yes. It's going to be $1 trillion. I mean, in the UK and there are publicly listed companies that are raising crowdfunding. So they don't need to issue shares on the exchanges. They can go on a platform, they get publicity. You know, they especially with the millennials that are now buying shares directly, it's you know, it's equivalent to buying shares not through a broker. But it's still your shares are still publicly listed. But unlike before, where you had to go through an exchange and fulfill the regulatory requirements, these are lower requirements because these are smaller companies. These aren't $100 million companies or, you know, $1 billion companies. These are smaller companies.
So a good area could be the moral hazard. The moral area. I mean, the ethical, like fraud happening in crowdfunding. A lot of
tons of fraud. It's the fraud research itself is quite interesting. You know, it's because nobody, and the thing is, these companies are so small, nobody really cares. That's why the Jobs Act says that you can actually sue the company directly and the directors. So there's higher fiduciary duties for the entrepreneurs to start up these companies. But in Delaware, these directors and founders can actually get indemnity insurance. So that's why now that's that we don't know, again, it's still very new. So we're not sure what legal, which legal requirement will override each other. But it is actually quite interesting. Yes, because of the risk and because you could, you could literally just take the money and go buy a yacht, right? It's there's nothing you can do.
Yeah. And the indemnity insurance is also helping those persons?
We don't know yet. So in Delaware, you can get, so we don't know how many companies have actually bought the indemnity. We don't have that data yet.
Okay. Thank you, Sofia. That was
That's a great area of research, just to see how, how the directors of these crowdfunding websites are reacting.
Yeah. Thank you.
Wonderful. Thanks a lot for all these questions and also for your patience. Before I close the session, I like to make an announcement. I think you are aware, all of you are aware that we are going to have our second annual conference in Istanbul between 24th to 26th of June this year. And please check out our website for paper submission. There are a number of journals are going to select papers from this conference as well. And you are welcome to submit your papers to the conference, and we are looking forward to seeing you in Istanbul. Thank you very much, Professor Sofia Johan, for your entertaining presentation. We really enjoyed the presentation. Indeed, I mean, a new topic for me. Of course, I learned a lot from this presentation indeed. And thanks again for coming along and supporting us in this initiative.
Thank you for having me.
Thanks a lot. And we'd like to thank University of Bradford as usual for their support, and all the audience for your time and effort to listening and asking questions. And we'd like to see you. We should be looking forward to seeing you in the future. Thanks very much. Thanks a lot. Thanks.
Thank you
Bye-bye.
very much.
Bye.
Thank you.
Thanks a lot. Bye-bye. Bye, Sophia. Thank you. Bye.